So here's our best guess. Our best guess was sometime late this year. It's November. So we're going to be wrong on that guess. Q2 right now is roughly the center point of our distribution as to when we're likely to see the United States in a recessionary environment.
Ken Griffin, the billionaire founder of Citadel, has expressed a stark warning about the current atmosphere of celebration over recent inflation reports. Despite a positive market reaction to better-than-expected inflation numbers, with bond yields falling and stock prices surging, Griffin cautions that this optimism may be premature. He suggests that the current spending patterns in the U.S., which he metaphorically compares to a drunken sailor, could mean that inflation might persist for decades. Griffin's concerns also extend to the possibility that markets and the Federal Reserve might be caught off guard by the return of inflation, especially since the current rate is below the Fed's target. He believes that the absence of stagflation, a stagnant economy coupled with inflation, is not a permanent state and warns that the markets will be entirely surprised when inflation resurfaces. Before we get started, click on the link in the description below to get your copy of The Fourth Turning, a book that will inevitably help you navigate the upcoming turn of the long-term debt cycle. Let's get started. In his interview, Ken Griffin expresses significant concern about the state of the U.S. economy, particularly focusing on the alarmingly high national debt, which he notes is around $33 trillion. This level of debt, a substantial portion of the country's gross domestic product, GDP, raises serious questions about the United States' long-term fiscal sustainability. Griffin warns of the implications of rising interest rates, both real and nominal, on the cost of servicing this massive debt. In an environment where interest rates increase, the cost of borrowing escalates, meaning a larger portion of government revenue must be allocated to interest payments. This situation leaves less funding available for essential services and sectors like healthcare, education, and infrastructure, potentially slowing down economic growth as borrowing becomes more expensive for businesses and consumers. Griffin criticizes what he perceives as the U.S. government's fiscal irresponsibility, particularly its excessive spending without adequate revenue generation, leading to a growing national debt. He suggests that such spending patterns are unsustainable and could lead to significant economic challenges, including reduced economic flexibility and increased vulnerability to economic shocks. The potential negative consequences of this fiscal trajectory include impacts on the U.S. dollar's value and the risk of a debt spiral, where the government borrows more to pay off existing debt, leading to an unsustainable financial situation. Griffin's comments reflect a broader concern among economists and financial experts about the long-term implications of high national debt in an environment characterized by rising interest rates and inflationary pressures. His emphasis is on the need for prudent fiscal management to ensure the country's economic stability and sustainability. Griffin addresses the complex issue of managing geopolitical risks within the financial industry. He underscores the critical importance of being prepared for a range of scenarios that could impact global markets, citing specific examples such as the ongoing war in Ukraine and the possibility of a recession in the United States. Griffin's emphasis on these examples highlights the interconnected nature of global events and their potential to affect financial stability and market dynamics. Griffin also delves into the broader concept of basic risk management, a fundamental aspect of financial operations. He stresses the need for financial institutions to have robust risk management strategies in place to navigate the uncertainties and volatilities inherent in global markets. This approach is not just about responding to immediate crises, but involves a proactive and comprehensive assessment of potential risks and the development of strategies to mitigate them. A significant point of concern for Griffin is the danger of asset-liability mismatches in the financial sector. This issue arises when the maturities or liquidity profiles of an institution's assets and liabilities are misaligned, potentially leading to liquidity crises or solvency issues under stress conditions. Such mismatches can be particularly perilous in times of geopolitical turmoil or economic downturns, where market conditions can change rapidly and unpredictably. Griffin's insights reflect a deep understanding of the complexities and challenges of managing risks in a global financial context. He advocates for a vigilant and forward-looking approach to risk management, emphasizing the need for financial institutions to be well-prepared and adaptable in the face of geopolitical uncertainties and economic fluctuations. This perspective underscores the importance of sound risk management practices as a cornerstone of financial stability and resilience. The conversation then shifts to U.S. China relations, particularly in the context of technology trade. Griffin discusses the complex trade-offs involved in restricting technology trade with China, acknowledging the strategic and security considerations while also pointing out potential drawbacks. He advocates for enhancing American competitiveness in technology and education to effectively compete with China on the global stage. Griffin suggests that focusing on domestic innovation and skill development is crucial for maintaining a competitive edge in the rapidly evolving technological landscape. Now, importantly, Griffin addresses inflation. Ken Griffin expressed caution when many market participants are expressing relief over recent inflation data, which has shown a more favorable trend than anticipated. This has led to a rally in the stock market and a decrease in bond yields, signaling investor confidence. However, Griffin interprets these signs with skepticism. His comments about U.S. spending patterns suggest he sees them as reckless and unsustainable, potentially fueling inflationary pressures for an extended period. He is particularly concerned about the lack of vigilance and preparedness among market players and the Federal Reserve, which he fears may be underestimating the risk of inflation making a strong comeback. Griffin warns that the current economic stability may be deceptive, and that the underlying conditions could lead to a sudden and unwelcome resurgence of inflation, catching investors and policymakers by surprise. His perspective is a sobering reminder that economic conditions are often cyclical and that current indicators may not always predict future trends accurately. So, be vigilant about the recent stock market rally and stay informed. How should you respond to this? If inflation, as Ken Griffin seems to imply, will stay elevated for a longer period of time, certain asset classes have historically shown resilience and can offer a hedge against the eroding effects of inflation on investment value. Real assets, such as real estate and commodities, are often favored during such times. Real estate can be particularly effective as rents and property values tend to rise with inflation, potentially leading to higher returns. Commodities like gold, oil, and agricultural products usually see price increases during inflationary periods, with gold being a classic hedge against inflation. Equities, especially stocks of companies with strong pricing power, can also fare well. These companies can pass increased costs onto consumers without significantly reducing demand, often due to strong brands or market dominance. Value stocks, in contrast to growth stocks, have historically outperformed during high inflation periods, as the future earnings of growth stocks are more heavily discounted when inflation is high. Inflation-protected securities such as Treasury inflation-protected securities, TIPS in the U.S., and inflation-linked bonds offer direct protection against inflation. These are government or corporate bonds where the principal and/or interest payments are indexed to inflation, thus preserving the purchasing power of the investment. Investing in foreign currencies from countries with lower inflation rates can also be beneficial, as these currencies may appreciate relative to the investor's home currency. Additionally, some investors view cryptocurrencies like Bitcoin as digital gold and a potential hedge against inflation, though this is a relatively new and highly volatile asset class. Dividend-paying stocks, particularly those with high dividend yields, can offer a buffer against inflation. The steady income stream from dividends, which may grow over time, can provide some protection against the decreasing value of money. Infrastructure investments, including utilities, energy, and transportation, can also be effective. These sectors often have the ability to pass on higher costs to consumers, offering some inflation protection. It's crucial to remember that while these asset classes can provide some protection against inflation, they come with their own risks and challenges. diversification across different asset classes is often recommended to mitigate these risks. Of course, none of this is financial advice. Thanks again for joining us today. Until next time.